So one of the common confusions that entrepreneurs have is this idea of profit on the accrual basis versus cash flow. And so one of the things that I developed that really helps drive this idea home is a series of graphs that I put together to help people understand this concept of why I need to know profitability on the accrual basis in a simple example versus when the cash flow shows up, and really drive home secondarily why profitability matters more than anything in terms of changing the outcome or the elements of the scenario. So what I'm going to show you is a series of charts that are based on 3 profit levels of 5%, 10%, and 15%. We're going to assume that each business they win a contract of $100,000 of revenue per month. So all of a sudden, immediately you're in business and let's get going. We're going to assume a tax rate of 40% because unfortunately, whether I need to pay the taxes eventually or not is not something that we really want you to get in the habit of holding that off. So we want you to set aside those taxes kind of as you go in that process and make sure that you don't get yourself caught in a situation where I'm spending tax money instead of spending my own money. And then we're going to assume that it's a service-based business that is built around collecting their receivables in 45 days. Now, what that means is in 45 days, sales and receivables is this. I start work for the first month of the year, so let's assume that's January. So I work for the full month of January. I send an invoice at the end of the month. And so now that customer has an invoice and the clock starts running on the invoice. And then I'm going to work for another 30 days, send the invoice at the end of February to that customer, and then the 15th of the third month I finally get paid. Now, from an accounting calculation, since I started the clock the day that I sent the invoice at the end of the first month, then that means that there was 45 days from the date I sent the invoice to when I got paid. The reality is add 30 to it because I got 30 days of cost before I even sent the first invoice. So most of the time I will tell you that when you're looking at day sales outstanding calculations for accounts receivable, just add 30 to it because that's probably how many cost days that you actually have in it. So let's look at the first example. So you can see that in the first month, I work for 30 days. I incur 30 days worth of cost. I have about 5% profit. So that means somewhere in the neighborhood of about $95,000 of cost I'm out of pocket. And so something's got to fund that. So you can see from the cash flow curve that I dig a hole in month 1 of about $95,000. I dig a further hole in month 2 because I sent the invoice at the end of month 1, but I ain't got paid yet. Into month 2, I still ain't got paid yet. So now I'm down slightly under $200,000 in terms of costs that are going outside of the business. And then in the third month, I start to inch my way up that I finally collect the invoice from the first month, and I've sent the invoice for the third month. And so those two start trading their way up. So here's the harsh reality. At 5% profit, it takes me 67 months to be cash flow positive. So how many of you really want to wait 67 months from the day I start to the day I finally get cash flow positive? Because most people think that when you're starting to go up the curve, that you're cash flow positive. Well, you are positive from, at least you're not losing more money every month, but until you get back above 0, you're not cash flow positive, from that regard, in my opinion. And so from that standpoint, I don't think I want a business that I got to wait 67 months to be cash flow positive if I have something better to choose from. So let's look at the second version. If I just change one thing, if I can get to 10% profitability, all of a sudden, instead of taking 67 months under all of the same conditions, I get profitable in 34 months. Now that's better. And actually, to be quite honest, this is the most common scenario that we see in most service-based businesses that take trade receivables. But if I can get it even further, if I can get to 15% profitability, I get to cash flow positive in 22 months. Now that's something that's getting a little more exciting from that standpoint. And so what you start to see from this standpoint that, granted, I want you to get as good a terms as you can from your customers if at all possible. But my belief is you got to be responsive to the marketplace. And if anything, we're seeing dramatic trends amongst the big companies out there of saying, I don't care what you want, you may want all your money up front or half of it up front, and then we'll bill you at the end. And they laugh at you and they say, how about 90 days? And maybe even 120. And so from that standpoint, you have to decide, as long as I'm profitable, that becomes a capital funding question that we'll address in a different presentation. But really, I've got to take a look at it and say, what are the market conditions? And based on those market conditions, do I have this many customers or this many customers? And so as long as I have the greatest amount of customers of equal profitability, but just different terms, then that's really just something that I have to fund and look at from a return on invested capital standpoint. And like I said, that's a separate discussion that we'll hit in another presentation. But really, I want to drive home with the fact is that really profitability is the main driver that changes cash flow more so than anything. Now, if I can get my day sales and receivable to drop from 45 to 40, that is a one-time benefit of cash. Now, it means I use less capital to turn over that business going forward, but I always have to be careful that, that also may be like, weeding my garden. So, I can get out there and dig up the weeds with a garden hoe, and guess what? The weeds will come back. If I put herbicide down and kill the weeds, they're less likely to come back. So do you have a process that's going to make sure that 40 days of human effort that I got it down from 45 to 40, is that going to grow back to 45 or even 50 because now it's out of sight, out of mind because I fixed it temporarily? And that's really the challenge that you got to look at and improve with processes and make that go. But the real crux of the matter though is profitability fixes more of it than anything. And so just focus on that and make sure that I have that in place first. Because if I'm not profitable, it doesn't matter how fast I collect my money. I'll eventually be out of business.